Right, the market was buzzing about talk of a correction since the run-up in March. We had a massive slump on Friday and, of course, the big slump on Monday, which made a lot of analysts think that this is the time for the correction. Is this what you think as well? Do you think that perhaps we will see more downside from here?
Well, if you think about it, the market since March has gained 35%. Now, the average gain for the market over the long term per year is about 15%. So in a period of about 4 or 5 months, the market has done over double that in a very short period of time. Now, I mean, think about it. The divi yield has become slightly more compressed due to this whole thing. But then again, we've also seen earnings sliding back, and we've seen an earnings correction as far as that's concerned. And then think about it as well in these terms. You've had some stocks that have done over 100%. And they include some big names. Think about people like Datatech and people like Old Mutual. Those are very large companies. Now, often the space for 100% gainers have often left for kind of mid-cap and small-cap companies rather than larger type businesses. Now, to try and get back to the highs that we had before, the market has to move another 25%. Now, this first 35% we've made, I think psychologically was the most difficult thing to do. Because think about it, you're sitting on the sidelines and you're going, it's cheap, but could it become even cheaper? And could it become even cheaper? And you sit and you watch on the sidelines while this thing is falling and falling and falling. And I'll voice one of the market participants that I spoke to during the March correction. He said to me, I'm sure there'll come a time that I'll make money out of this market again. And that's quite true. But from a market perspective, it was probably the easiest money that you would have made, because you've made an awe-inspiring amount of money very, very quickly. But the next 25% is going to probably be slightly more difficult. Psychologically, it's going to be easy to put money in the market now because the bad news is gone. But from a market perspective, you need some really, really good news to fire the market back up. And that's why you see this kind of on a knife's edge. You see the market selling down aggressively and then starting to buy up again. And obviously with that, there's great buying opportunity because, there's certain stocks that get hammered a little bit more than other ones, and that gives you the opportunity to buy and get into those stocks and so on. So if people continue to deploy capital and continue to deploy cash in these markets, it continues to be cheap and it continues to be good to have money and then own it for long periods of time.
People were expecting a correction. People are still expecting a correction. Are you expecting a correction in the markets? Many say that we're going to see a double dip recovery and the markets could go down a further 10 to 15%.
But if you think about it, if you have a 10% correction in the market, there's even more buying opportunity. So surely if you're contributing capital today and you're increasing and you're putting capital...
What you're saying is regardless of where the market is going, you should be putting money in today.
Well, think about it. If you're going to own stocks for 10 years, it doesn't matter if the market is down an extra 5 or 10 or even 15% tomorrow. If you're continuously contributing capital towards the market, surely that's the right thing to be doing because you're owning these businesses for long periods of time. Remember that time is a very, very important component in markets because time allows for compounding to happen. And compounding also allows for these anomalies to work themselves out of the market because markets always revert back to some form of average or some form of mean in the long term. So if you like Sasol or you like Billiton or you like any of the businesses out there and you're buying today and maybe you're keeping some money back because maybe there'll be a 10% correction at some point and then you're putting more money in the market, surely that's a wise thing to do at these levels.
Cobie, you were talking about the psychological perspective of an investor, and it seems that investors were panicking to get out of the market prior to March, and now investors are panicking to get in right now. And a lot of people find it quite difficult and say, well, should I get in right now or should I wait until the market loses a further 10%? You're saying that if you like a company, you should just head right in there.
Well, let's look at it this way. The compounded growth rate for the market over the last 5 years, okay, so this is now half a decade, is in the order of about 25% per annum. Way, way in excess of what the average is for the market, is about 15% per annum. So that means people that got in the market 5 years ago would have had this fantastic rates of return in the market, regardless of thinking about valuation, if I should, if I shouldn't, psychologically, does this feel right and does this feel wrong? Because let's face it, if it psychologically feels right and we can tick absolutely all the boxes, well, guess what? The market's going to be fairly priced and there's going to be no more opportunity. And that's why psychology works contrary to what the market indicators would indicate.
You mentioned Datatech and Old Mutual gaining over 100%. Sappi, Sovereign Foods, Lonrho, Merafi, Transex and Metarex also in that bag, and a mixed bag of companies, some big, some small.
I mean, if you think about it, usually what happens is a lot of investors will tell you, look, I want to be in mid-cap or small-cap companies. I don't want to be in large companies because that's where you can make the big money. You know, if there's an earnings revision, then this business can increase by 50, 60, 100%. We've seen very, very large names, you know, gain 100% in value in a very, very short space of time. The market literally obliterating them, basically selling them off like they're going out of business and they will never make money ever again. And then immediately starting to rise again in value as that sentiment then turns and people say, well, hang on, I think these people will make money again. I think this business will survive. And that's now in the large cap space. So you think about it, you've actually had to take very little risk putting money into a large cap. You didn't have to assume the risk that you had to assume in a mid-cap and a small-cap market. And that's the beauty of an abnormal market, is that you can make money in stocks such as large caps.
So we mentioned these companies that have gained over 100%, but we need to appreciate as well that it comes off a very low base for most of these companies.
Absolutely, yes. I mean, earnings obviously have been hammered in most of these businesses. I mean, you know, take the mid-cap and small-cap businesses out of the equation, I think, because mid-caps and small-caps generally behave in this way. Let's look rather at the large caps. There were massive earnings revisions in many of these businesses. In some instances, they suspended dividends because of the environment they were in. And in other instances, there were ulterior factors also impacting on the company's ability to make money and on the industry as a whole. And I think all those things, obviously, if you add all those things in together in the pot, you've had this abnormal selling of the company. And obviously, now that we've turned the corner, people say, well, hang on, you know, they'll make money again. Maybe not as much as what they made in 2007 and 2006, but they certainly will make money again. And surely that's a reason to buy these stocks.
Well, these companies that have gained over 100%, do you think perhaps they are looking a little expensive right now?
Well, many of those are still sitting on fairly decent dividend yields. They're still sitting, and I mean, those are, and you can look at the earnings yields, you can look at the PEs, and what the market is not pricing in is the ability for these companies to start making money at some point again. So what you should really be doing now is you should be looking through 2009 and looking through into 2010 and 2011 and saying, well, these businesses will make money. Look, there's no doubt we're in a bull phase. We're not in a bear phase. You know, we either at the very beginning of it, or we maybe 2 or 3 weeks, or maybe a month or 2 months or 6 months into that. And with that, there's going to be some form of pain. Maybe with that, there's going to be some form of gain.
Cobie, you said that the markets need to gain a further 25% before we see those highs that we saw in March last year. Do you think that we will get to those levels? And what do you think that needs to happen to get to those levels?
Look, I think the markets will attain those levels at some point again. Remember that that point in the market is also based on a very specific earnings number for the market as a whole, which by default means there's an earnings number for each company that's obviously wrapped into that. That also depends if we get back to those earnings numbers and how long it takes to get back to those earnings numbers. Certainly, what the market is doing today is the market is saying to you, we're not going out of business, we are going to continue to make money, but how long this takes, we don't know. And that's why the next 25% is probably going to be a slightly more difficult money to make. Psychologically, the easier money to make, but from a market perspective, the more difficult money to make. Because now you need to actually put, you know, you need to make sure everything's in place, you know, in order to make the money.
South Africa is still in a recession, contraction of 3% for the second quarter, slightly better, well, much better actually, from the first quarter number, a negative 6.4%. What do you make of that GDP number? And we've got to also appreciate that with the negative GDP number, with South Africa in a recession, we still see a lot of job losses, and of course the consumer is still very much under pressure when you look deeper into that number.
I mean, GDP is a post-looking number, so it's not looking forward. It's saying what has happened in the past. Now, remember that when companies produce earnings, it's also a backward-looking number. It says over the last 12 months we did X, and over the last 3 months we did Y. So the fact that we've contracted by 3%, you know, as far as GDP is concerned, is in line with what expectation was. It's in line with what the world, what is happening across the globe. And from those numbers, if you look forward, it has to get better at some point. And I think that's the important thing, you know, is rather than pinpointing exactly where GDP growth is going to be and exactly where unemployment numbers are going to be and so on, it's what does the overall picture tell you about the situation of the world today, and what is the opportunity in that, and basically looking at that opportunity looking forward.